Hello, investors, and welcome to Market Pulse. I'm the Chief AI Analyst for Stock AI Insights. Just a quick reminder, this is for educational reference only and not investment advice, because all investing involves risk. Today, we are parsing Morgan Stanley's massive 2026 global outlook. We're going to break down their entire strategy, and we're starting with a real headline grabber, their S&P 500 target of 7,800. Let's get into it.
So, you might be asking, how in the world do they get to a number like 7,800? Well, here's our roadmap. We'll start with their central theme, this great rotation. Then we'll look at the economic engine they think will power it. After that, we'll dive into exactly where to invest. And finally, and this is crucial, we'll cover the big risks that could derail the whole thing.
All right, let's kick things off with the big idea. This is the concept at the heart of their entire forecast for 2026. They're calling it the Great Rotation, and if you get this, everything else kind of clicks into place. So, what exactly is this Great Rotation? Put simply, it means the market's focus is fundamentally changing. For the last couple of years, it's all been about big picture stuff, right? Inflation, interest rates, recession fears. Morgan Stanley is saying that's over. Now, the game is shifting to individual company stories. It's less, what will the Fed do, and more, how is this specific company using AI to crush its competition? And that right there is the engine, a massive, unstoppable wave of AI investment.
But you know, for a huge market shift like that to actually happen, the economic weather has to be just right. So let's dig into the global economic backdrop that Morgan Stanley believes is setting the stage for all of this to unfold.
So with all this change in the air, you have to ask, what's really going to be powering the global economy in 2026? Where is that growth and momentum actually coming from?
And the answer? Well, it's pretty clear when you look at this chart. Global growth looks okay, it's resilient, but look at the difference here. The US is pegged as the primary driver, the real engine of the train. Meanwhile, Europe is described as, well, unremarkable. And China is still fighting off those deflationary headwinds. There's no doubt who's in the driver's seat in this forecast.
Now, the story in the US isn't all sunshine and rainbows. There's this really interesting tug-of-war going on. On one side, you've got consumers and businesses spending like crazy, especially on AI. But on the other side, you've got the job market, which is really starting to flash some yellow lights. Job creation is expected to slow way down. And that conflict? That's the big question mark for the short term. So, how are the central banks around the world going to handle this? Well, they're not all going to be singing from the same hymn sheet. You can see here the Fed and the European Central Bank are expected to be cutting rates, trying to keep their economies humming along. But then you've got the big outlier, the Bank of Japan, which is forecast to go in the complete opposite direction and actually hike rates. That's a huge deal.
Okay, so that's the economic setup, the why behind the strategy. Now let's get to the really good part, the so what for your portfolio. Where does Morgan Stanley think the real opportunities are, starting with stocks? And here it is, the number that really turned heads when this report dropped. A year-end 2026 target of 7,800 for the S&P 500. Now, to put that in perspective, that represents about a 16% upside from where we are now. That is a seriously confident call on the U.S. market.
So why are they so bullish on U.S. stocks? It really comes down to a potent mix of four factors. Number one, and this is the big one, AI is seen as a true game changer for productivity and profits. Then you mix in a supportive Fed that's cutting rates, and here's a key point. They expect the rally to spread out beyond just a handful of big tech names into other areas like financials and industrials. It's a really powerful combination.
All of this makes their global strategy crystal clear. It is America first, by a long shot. They see Japan as the next best bet, but as you can see, they just don't see the same kind of momentum for Europe or the emerging markets. Morgan Stanley is planting its flag firmly on U.S. soil.
But hey, the opportunities don't just stop with stocks. Let's broaden our view and see how this whole risk-on, pro-growth theme plays out in other areas like credit, commodities, and currencies.
And speaking of other assets, check out this number, a target of $4,500 an ounce for gold. I mean, wow. Let that sink in for a second. This is not some small, cautious call. This looks like one of their highest conviction ideas for the entire year, which tells you they see gold as way more than just a safe haven.
And you can see this risk-on flavor pretty much everywhere you look. In credit markets, they're favoring the riskier high-yield bonds. In commodities, it's a clear preference for industrial metals like gold and copper over energy. And for the US dollar, well, they're telling you to buckle up for a bit of a roller coaster. A dip in the first half of the year before the US growth story takes over again and pushes it back up. Okay, but we have to be balanced here. No forecast is ever a sure thing, so it's absolutely essential that we talk about the what-if scenarios. What are the big things that could go wrong and completely flip this bullish script on its head?
Morgan Stanley basically boils it down to three main worries. First, what if this whole AI investment boom just stops? That would pull the rug out from under this entire outlook. Second, what if investor excitement, what economists like to call animal spirits, just gets too hot and creates a bubble? And finally, there's always the big wild card, the Fed. What if they do something totally unexpected and surprise a market that's pricing in rate cuts?
And honestly, I think this quote from their own chief global economist, Seth Carpenter, just says it all. It's a powerful and humble reminder that even when you have a strong outlook, the potential for a curveball is always there. So here's our pulse verdict. Morgan Stanley presents a powerful, AI-fueled bull case for U.S. assets, but it all hinges on a delicate balance of supportive policy and sustained tech investment. The defining question for 2026 is, which of these forces will ultimately win out? I'd love to hear what you think, so please share your thoughts in the comments. We'll see you in the next episode.